Nuburu Inc. is currently trading at a live intraday stock price of 0.1504 per share, registering a slight upward tick of 0.74% during this active trading session on June 16, 2026. While a sub-dollar share price typically signals distress or extreme retail speculation to the average observer looking at micro-cap tickers on an online brokerage, what the broader market fails to realize is that Nuburu is quietly attempting to reshape its entire identity through aggressive European defense acquisitions and specialized industrial agreements. The immediate insight here, which completely defies the narrative of a dying microcap stock, is that the company has recently finalized its golden power notification with the Italian government to acquire a controlling 70% stake in Tekne. This specific transaction gives Nuburu pro-rata exposure to a massive projected revenue pipeline of approximately $459 million between now and 2030, a figure that dwarfs its current microcap status and introduces a layer of fundamental valuation that completely catches the retail trading community off guard. The common ground among most investors utilizing a popular online investment app or seeking self-investing paths on major investing sites is that Nuburu stock is a high-risk gamble teetering on the edge of delisting, driven purely by standard penny stock volatility. It is easy to see why this belief persists when you look at the 52-week high of $4.24, contrasting brutally against a 52-week low of 0.14 cents. However, a closer look at recent institutional intent and strategic positioning reveals a contrarian reality. The company is actively executing a blueprint to serve as a specialized defense and security infrastructure player rather than just a commercial component supplier. For individuals managing an individual brokerage account or looking at specialized exchange-traded products like Fidelity ETFs, finding a company valued under $30 million with deep integration into European national security assets is incredibly rare. When analyzing the aggressive daily swings and trading volumes that define Nuburu stock today, we see an intense battle between legacy retail bag holders and specialized accumulation. The average trading volume sits remarkably high at over 42 million shares, while today's active volume of over 17 million shares shows that liquidity is flowing heavily through the ticker. This massive volume relative to its small market capitalization indicates that big hands are repositioning. Retail platforms like the Robinhood app or users executing trades via active online investing tools are seeing massive order book imbalances. This institutional churn is directly tied to the geopolitical complexity of their recent business moves. Buying into a company that requires a foreign government's approval under national security laws creates a long waiting period, which suppresses the stock price while smart money slowly builds positions. To understand the current tension between expectation and reality, we have to look closely at the macroeconomic pressures hitting the hardware manufacturing sector. High interest rates have made it incredibly expensive for small companies to fund operational expansion. This has forced Nuburu to seek capital and revenue generation outside standard domestic markets, leading to their strategic alliance with Italian firm SunCubes to form a specialized laser arm within their defense platform. This alliance targets the fast-growing directed energy and counter-drone markets across the United States and European allied regions. While the general expectation was that Nuburu would run out of cash and face bankruptcy, the reality is that they are structuring international partnerships that rely on external capital injections, such as the staged investments through their subsidiary Lyocon, to fund advanced development without heavily diluting current shareholders at these rock-bottom prices. Let us widen our view to see how this fits into the broader modern retail landscape, where self-investing tools have democratized access to highly speculative companies. Investors browsing top investing sites or shifting capital away from automated solutions like Schwab Intelligent Portfolios towards hands-on trading on an interactive brokers platform are increasingly hunting for microcaps with legitimate defense applications. The exponential rise in drone warfare has turned counter-UAS technology into a high-priority sector globally. Because traditional defense giants are slow to iterate, smaller, nimble players are capturing highly specialized niches. Nuburu's blue laser technology presents a clear physics advantage in underwater power beaming and maritime infrastructure, which was highlighted by their recent agreement to design solutions for the SunCubes underwater power platform. Comment below how many shares of Nuburu stock you currently hold, or if you prefer sticking to large-cap defense companies. To properly evaluate where the business stands today, we need to look at what the underlying company actually does and how its core operational model functions. Nuburu is fundamentally an industrial hardware developer specializing in high-power, high-brightness blue laser systems. Historically, standard industrial lasers have operated in the infrared spectrum, which works well for steel but is highly inefficient when processing yellow metals like copper and aluminum. Blue light is absorbed by these metals at a rate up to 20 times higher than infrared light, meaning Nuburu systems can weld and print multi-layered electronic components with unparalleled speed and minimal thermal defects. This technology is incredibly relevant for electric vehicle battery manufacturing, consumer electronics, and aerospace manufacturing, which are all heavy users of copper components. The past performance metrics and older financial reports, however, illustrate why the stock has experienced such severe downward pressure over the past year. Looking back at the quarterly numbers from late 2025 and early 2026, the company was burning through cash with an operating loss of over $7.9 million in the first quarter of 2026, against a very modest revenue base of around $407,000. Selling, general, and administrative expenses have historically consumed the vast majority of their capital, creating a structural deficit that required constant financial restructuring. This severe cash burn explanation is why the market punished the stock so aggressively, driving it down from its multi-dollar heights to the current penny levels. It was a classic example of an incredible engineering breakthrough failing to find immediate, scalable commercial adoption, forcing the business to pivot its target market from commercial factories to government defense contracts. This brings us to the core of the expectation versus reality dynamic and will dictate the future outlook of this stock. The market's expectation is that the historical cash burn will inevitably lead to total capitulation or massive dilutive equity raises that wipe out retail investors on platforms like Robinhood stock trading or Fidelity Investments. The reality, however, hinges entirely on the successful execution of their international roll-up strategy. By integrating software command layers via their planned acquisition of Orbit, which recently secured critical infrastructure orders from a major national telecommunications operator, Nuburu is trying to transition into a high-margin software and hardware defense platform. If the Italian government approves the Tekne deal and those projected revenues begin materializing on the balance sheet, the financial reality will completely shatter the current market expectations, potentially causing a massive re-rating of the stock. On the flip side, the risks here are incredibly steep and cannot be ignored by anyone engaging in self-investing. Regulatory hurdles are the most immediate catalyst for failure. If the Italian government invokes its national security powers to block the acquisition, or if the integration of these foreign entities stalls, Nuburu will be left with its legacy cash-burning business model and limited domestic options. Furthermore, maintaining a listing on a major exchange becomes a constant battle when your share price hovers around 15 cents, presenting structural delisting risks that often force reverse stock splits, which retail traders on basic online investing sites generally view with deep skepticism. Investors managing individual brokerage assets must balance the massive upside of a successful defense pivot against the very real possibility of total capital loss if the operational transition falls short. Looking forward, the ultimate trajectory of Nuburu stock will be decided by its upcoming earnings reports and official corporate updates regarding government approvals. If you are tracking the stock through comprehensive market tools like an interactive broker's account, a Fidelity trading platform, or a modern robo-advisor setup like SoFi Robo-Advisor, you need to keep your eyes locked on institutional order flow and contract announcements, rather than short-term retail hype cycles. The business is walking a very thin tightrope between severe financial distress and a massive structural turnaround. The current stock price of 0.1504 reflects a market that has priced in near total failure, leaving massive room for exponential upside if management can actually deliver on their multi-hundred-million-dollar European defense projections. In summary, the story of Nuburu is a stark lesson in how market expectations can become entirely detached from emerging corporate realities. The market looks at the historical losses, the depressed share price, and the heavy retail churn across mainstream platforms like Robinhood Crypto or simple investing sites, concluding that the company has run out of runway. Our deeper analysis reveals a completely different narrative, a business desperately and strategically shifting its weight into international defense applications, blue laser maritime infrastructure, and sovereign government partnerships. Whether this ambitious pivot ultimately succeeds or ends in financial failure depends entirely on execution, but for the alert investor, the contrast between what the public expects and what the operational reality presents is where the true market opportunity resides. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Thumbs up, don't forget to like, comment, and share this video to support the channel.